On the surface, today looked pretty uneventful with stocks barely making any moves and headlines were overall pretty quiet. Everything just felt stable. But under the calm, we got signals that smart investors are paying close attention to, from PMI data to jobless claims and even Trump making an unexpected visit to the Federal Reserve. The economy just whispered something, and the question we need to be asking is, are we paying attention? So a quick look at stocks, we see volatility still at historical lows, and overall, if we zoom out, there weren't a lot of big moves today. Even though there's been this FOMO, fear of missing out, chasing the uptrend, stocks reaching new all-time highs, today was just pretty calm and not big old moves in the stock market, which is weird given this risk-on trade, this trend that we've been seeing for weeks and even months now. That's really been driven by, guess who? Retail investors. So that's what this article right here talks about by Steve Goldstein. Retail investors are driving this market and Wall Street knows it. And they kind of talk about what they expect stocks to do considering this trend. And they start off talking about how retail investors are a huge player in this market. And they go on to talk about Barclays strategists' metric that they made and created called the Equity Euphoria Index. And what this measures is the percentage of stocks in euphoric territory, which has now surged towards its highest level of the year, which could be reflective of market conditions given this risk-on trade with options trading and how people are checking out these leveraged ETFs. It's really risk-on out in the stock market. And they expect, given this, I'm getting ahead of myself, retail investors have forced repositioning onto institutional investors, but not so aggressively risk-on positions, which is why I think the pain trade may still be higher, is what Liz Ann Saunders, chief investment strategist at Charles Schwab, had to say. So she sees stocks going higher than where we're at since institutional investors haven't got so risk on yet. It's just been retail investors. But note, retail investors are usually the ones that get screwed at the end of the day. So whichever moves go, it usually benefits institutional investors the most. Fact check me on this one. You'll probably be surprised by what you find out. These funds, however, could also ratchet down their exposures depending on how the upcoming August 1st tariff deadline comes, what the Fed does with their interest rate decision on this July 30th meeting, which, I mean, come on, y'all. Nobody thinks the Fed's cutting interest rates at their meeting next week unless something terrible comes out between now and then that forces them to. So far, the data is looking pretty good, so nobody's really expecting them to cut rates. And earnings, how earnings play out, which overall earnings have been pretty good. So based on the data that we've seen today, we got S&P PMI data, Purchase Manager Index. And what we see is that there was this growth accelerating in July as rising demand for services offsets the manufacturing dip. So to sum it all short, the data was unevenly strong, leaning towards services, which jumped to 55.2 in July from its 52.9 in June, now sitting at its 7-month high. But on the other end, manufacturing landed at its 7-month low, hitting 49.5, which is down from its 52.9 in June, showing a contraction because when it falls below that 50 figure, that is the sign of the economic contracting of the whatever space we're looking at. So right now, the manufacturing sector. And above 50 would show expansion, which the services side is expanding. And I wanted to scroll down real quick because what we see is that price pressures intensified across both manufacturing and service sectors during July, widely blamed on higher good prices due to tariffs, but also in some cases due to rising labor costs. Average prices charged for goods and services rose at a rate just shy of May's recent high to register the second strongest month increase since September 2022. So let's break this down. Good data. The headline data is pretty good overall. Growth accelerates. Inflation is showing up due to tariffs. What do you think that means for the Fed? and especially at this next interest rate decision. Completely off the table, the data's looking pretty good, and we're not even through the data yet. We still got more data to look at. But before we even get there, 97.4% chance at their meeting July 30th. What about September? Fell a little bit. We were just at 61% yesterday, but still over 50%. So it's still likely, hey, we're going to get this cut in September. If we don't, maybe start reconsidering some things. The economy's just completely resilient like the banks have let us know. But let's get back to the data, because for the 6th week, we see jobless claims on this downtrend. And this is kind of huge because claims are continuing their downtrend for the 6th week in a row, coming in at 217,000 for last week versus the prior week before that, landing at 221,000 the week before. So we went from 221,000 to 217,000. So claims are decreasing versus we were expecting today's number, that 217,000 figure, to come in at an increase 227,000, which we've seen a fall instead. So claims are going down. The job market's still holding up. So that's another positive set of data that we're getting. Hence, hinting at, all right, the economy's still holding up pretty well. Jobs aren't falling apart, even though Intel just announced they're going to lay off 15% of their workforce. And just to estimate, I looked up on Google how many people Intel employs, and let's say approximately 100,000. It was more than that, but 15% of that would be 15,000 jobs. Now back to this jobless claims data. We've seen continuing claims continue to rise to higher levels, reaching 1.96 million for continuing claims. So overall, the jobless market's holding up pretty well. More people are on unemployment though, so that's a lot of people seeking or benefiting from pretty much free money while they look for jobs or not. But the news doesn't end there. So this was a positive overall. Continuing claims went down versus the increase we were expecting. S&P data shows services and growth overall, and inflation, and people making more money. So overall, that's pretty good. Stocks didn't really move. But we also seen Trump decided to visit the Federal Reserve today. And what he wanted to do is really tour the headquarters, focusing on what's going on with these renovations of these two historical buildings that'll cost $2.5 billion. That's an expensive renovation budget, which according to Trump, he says that budget is now $3.1 billion. So he's like, let me check this out. I don't plan on firing Jerome Powell, but if there's like some mishandling, recklessness, or fraud in relation to this renovation, there may be some means to legally remove this guy. Overall, he doesn't want to, so he says. But before we get into his response, and I'll pull this up on my phone while I'm talking, I seen that there's this summary that the reason the renovation budget is so high is because costs have gone up. There's this groundwater problem with this flood or something. There's asbestos. Asbestos. I don't know how to say the word right. Maybe I'm saying it right. Toxic soil and material costs are what's driving up this cost of this renovation. And Trump's response was, hey, I think these renovation costs are kind of high because according to Trump, he renovated the old post office on Pennsylvania Ave and it was a roaring success. The total construction cost was a small fraction of the Fed's building costs, and it is many times the size. With all that being said, let's just get this done and over with, and more importantly, let's lower rates. So if anything, Trump fishing around the Federal Reserve today and nitpicking it like, those costs are pretty high, but Jerome Powell, I still want you to cut rates, sir. Because this concern here is that, hey, you can't cut rates, but you could go spend billions of dollars on this renovation for the Federal Reserve building. Who even knows why? And yet the entire American public is paying these super high interest rates. And then on top of that, they're going to have to pay for this $1 billion renovation budget. So a lot of people are wondering what's going to happen with this. There's more pressure from Trump to cut rates. It's really showing he's like fishing. And you know Trump, he's not going to announce it then and there. He likes just popping out of nowhere. So he's not going to announce he's going to fire the guy then and there on TV with his advisors next to him and Jerome Powell there. He's going to like marinate on it a little bit. And it's like out of nowhere when this man strikes. And then it's back to the question of the Federal Reserve's independence, how the dollar's impacted, how the stocks are impacted. But overall, stocks, we've seen not many moves today. But, I mean, it's kind of like you pick your poison here because we got high interest rates caused by the Federal Reserve, which Trump keeps on bashing. But what if the Federal Reserve came out and started bashing Trump for his tariffs, which, just like interest rates, increase the costs for both consumers and businesses? I guess the government doesn't have to pay high interest rate costs due to this because they're getting revenue from that. But overall, businesses and people are paying a higher tax due to tariffs. And we were expecting this 10% baseline, but what have we been getting? Much higher than that. It's more like a 15% baseline and up from there. I mean, the UK got a 10% tariff baseline, but other than that, we've gotten 15% on Japan, 19% on the Philippines, 19% on Indonesia, and then everything else is just higher than that. We got the European Union, they're eyeing this flat 15% tariff rate, and that's a huge trading partner. So if they get that, pretty much 15% across the board. We see Canada, they're not happy with the rate that they were projected, threatened in the tariff letter, and we still don't know what's going on with China, India, Mexico, South Korea, and any of these could land anywhere. And leading up to this August 1st deadline, we're expecting to see that more letters have gotten sent out. We're expecting to see more deals being made, and it's just really, where do these numbers fall? And so far, the numbers are falling higher than because we got the Liberation Day, and then Liberation Day was worse than expected, and then they were dropped, and then delayed, and then illegal, and then they're back, and then there's this 10% baseline to start and negotiate out from for most countries, and now we're getting higher than that. So what the market was pricing in ends up being worse than what the market was pricing in for, and they can continue out worse. Watch China and the European Union and India and Mexico and Canada. I mean, even Brazil, 50% tariff on Brazilian goods. So those are going to be some key players to watch out for and where these numbers come in and inflation impacts due to that, because that can really move the needle here. And how and what that leads the Fed to react as. So overall, the quiet days in the market often go unnoticed, but that's when the groundwork is laid for what comes next, and we can't be blind to it. Whether it's this strong services data, shifting jobless trends, or even moves made in Washington by the Trump administration. Today's calm might just be the warning before the next wave. Markets never sleep, even when it appears so. So we'll keep on watching what's going on, everybody. I'll be back tomorrow. Hope your night's a blast, and I'll see you next time.